For months, the big question in markets was always about inflation. Would it go up? Would it come down? And what would the Fed do about it? But lately, something interesting has been happening. Inflation numbers are finally starting to cool off, which should be good news, right? You'd expect bond yields, which reflect borrowing costs, to come down too. But they haven't. Long-term yields have stayed stubbornly high, even climbed at times. This tells us the market's focus has shifted. It's no longer just about consumer prices. There's a new, massive factor at play, and it's the sheer size of the U.S. national debt. Let's dig into this divergence. We've seen several reports indicating that the pace of price increases is slowing down. From your grocery bill to gas prices, the intense pressure seems to be easing. Historically, when inflation cools, the market anticipates that central banks will ease up on interest rate hikes, and bond yields would follow suit, trending lower. But today, the story is different. Long-term Treasury yields, which are the benchmark for borrowing costs across the economy, are staying stubbornly high. This isn't just a minor blip. It's a significant signal that bond investors are looking beyond immediate inflation figures and seeing a different kind of risk. A risk related to the government itself. This shift is critical. The market narrative has pivoted from price stress, how much things cost you at the checkout aisle, to debt stress, how much it costs the government to finance its operations. The U.S. national debt is enormous, and it's growing. When interest rates are high, the cost of servicing that debt, meaning paying interest on it, skyrockets. This puts the Federal Reserve in an incredibly tricky position. If they continue to hike rates to combat any lingering inflation, they risk making the government's debt burden even worse. It's a tightrope walk where every step has massive implications, not just for you, but for the entire federal budget. So, how does this actually work? It's a fundamental supply and demand dynamic. When the U.S. government runs a deficit, meaning it spends more than it takes in through taxes, it has to borrow the difference. It does this by issuing more Treasury bonds. Imagine the market as an auction house. If the government floods the market with a huge supply of new bonds, it has to offer a higher interest rate, a higher yield to attract buyers. This increase in government borrowing costs then ripples through the entire economy. It makes mortgages more expensive, corporate loans pricier, and essentially raises the cost of capital for everyone. It creates a self-reinforcing feedback loop. More debt leads to more bond issuance, which leads to higher yields, which makes the debt even more expensive to service. Historically, the Federal Reserve's primary mandate has been clear: maintain maximum employment and ensure price stability. This is their dual mandate. But the current fiscal situation introduces a powerful, albeit implicit, third constraint. The sheer scale of the national debt means the Fed can no longer ignore the government's borrowing costs. If rates get too high, too fast, the interest payments on the national debt could become unsustainable, potentially leading to wider economic instability. This forces the Fed to consider fiscal health alongside inflation and employment. It makes their job vastly more complex, turning monetary policy into a delicate negotiation between economic growth, price stability, and the solvency of the nation's balance sheet. So, what should you be watching? First, keep an eye on Treasury issuance schedules. How much debt is the government planning to sell, and when? Larger than expected issuances could put upward pressure on yields. Second, pay attention to political debates around fiscal policy. Any serious discussions about spending cuts or tax increases could signal a shift. Third, dissect every word from Federal Reserve officials. Look for subtle shifts in their language, any mention of fiscal implications alongside their usual monetary objectives. Finally, observe how bond markets react to these signals. A strong negative reaction to new debt announcements could indicate growing debt stress. This isn't just about bond traders. It affects everything from your mortgage rate to the stock market. The bottom line is this: the national debt is no longer just a distant political talking point. It's a powerful force actively shaping market dynamics and the Federal Reserve's decisions. Understanding this shift from CPI-driven policy to one heavily influenced by fiscal realities is crucial for navigating what's ahead. For a deeper dive into these mechanics and what it means for your portfolio, head over to korra.finance.